Hey, welcome back to YT Finance, and this is the channel where I went to business school so you didn't need to, and today we are talking about Palantir Technologies PLTR stock, new holdings, Tattooed Chef, and FUBO TV. We're going to be going over all of their latest news updates and price targets among professionals, and if we should buy or sell these particular companies. We're going to start off talking about Palantir and how the US Army Research Lab has extended their contract and agreement with Palantir so they can help deliver leading artificial intelligence and machine learning technology to the Department of Defense. Then we're going to move on and we're going to talk about how Palantir Technologies has continuously done business with Big Bear AI to further the military's capacity for machine learning. After that, we're going to move on and we're going to talk about New Holdings, which is a fintech company and a digital bank that's located over in Brazil that is an extremely impressive growth stock. From then on, we're going to go and talk about Tattooed Chef, which used to be a very prominent stock in the stock market, but recently it's dipped so low that we're going to determine if it's a good buying opportunity right now, even after the company burned through around 80% of their cash reserves. And then we're going to conclude the video talking about FUBO TV, which is another growth company that has been hit very hard lately due to macroeconomic factors. So for more videos like this one, remember to go and smash that like button right now, comment your thoughts down below on any of these companies, subscribe if you are new, and without further ado, let's jump right into today's stories. So Palantir Technologies is a big data and analytics company that serves both commercial clients as well as government enterprises, and recently the PLTR share price has surged to around $8.40, while professionals believe the company could be worth anywhere between $6 and $20 over the next 12 months. The reason why the stock price is currently rising in their share price right now is because of this amazing contract with the US Army. So what does this contract entail? Well, Palantir Technologies announced that they have extended their partnership with the US Army Research Laboratory, and they're going to extend that contract to support various branches such as the Armed Services, Joint Staff, and Special Forces to scale their artificial intelligence capabilities as well as their machine learning across the entire Department of Defense. This is a giant contract that could be worth up to $229 million for Palantir Technologies. So this is absolutely huge. Palantir's president of their USG segment actually had to say this, and I quote, "By bringing leading artificial intelligence / machine learning capabilities to all members of the armed services, the Department of Defense continues to maintain a leading edge through technology and by delivering best-in-class software to those on the front lines." He goes on to say, "We are proud to partner with the Army Research Lab to deliver on their critical mission to support our nation's armed forces." So this is a fantastic contract, and I like how Palantir is capitalizing on their existing relationships with large government entities to even double down on their overall agreements, so they're going to have a continuous revenue stream just from this one contract. Again, Palantir specializes in big data analytics for both commercial clients as well as government enterprises, but clearly their government contracts are their bread and butter, even though in the future I believe it's going to be their commercial contracts and their commercial revenues that push the company toward profitability at the end of 2025, so you may want to accumulate shares before 2025, although right now the PLTR shares are trading at a big premium, so always make sure to do your own research. In response to Palantir landing this phenomenal contract, the Senior Vice President of Innovation for the federal government said, and I quote, "Our work with ARL has enabled users in the field to accelerate the use of AI/ML in support of some of the most critical national security challenges our country and our allies are facing today." So clearly, they're very impressed with Palantir's technology, and it wouldn't surprise me to see them increase and further double down on their relationship with Palantir in the future, because Palantir has a goal to become the #1 default operating system and technology platform for the United States government. Palantir has had multiple contracts and agreements with the Army Research Lab going all the way back to 2018. Also, for artificial intelligence, Palantir was ranked as the #1 artificial intelligence company in 2021, which beat out companies like Amazon, Microsoft, and Google. So clearly, this company could be a huge AI play from now on and well into the future. Speaking about AI, Palantir has great relationships with Big Bear AI, and these two companies have joined together to implement and create a global force information management system for the Army's enterprise-wide intelligence and automation platform that provides their leadership with quote-unquote holistic view of its global force structure. So basically, it helps the management and the overall generals to make very wise decisions. And this contract is around $14.8 million, and it has a duration of 9 months. However, Big Bear is clearly the prime on this contract, so we don't really know of this $14.8 million contract how much Palantir is going to get from that. But again, it's really good that Big Bear AI and Palantir, who already have mutual agreements, are working on a cooperative effort for the United States, which is absolutely phenomenal. So overall, I think Palantir's PLTR stock is still overvalued right now, but I do think if you plan to hold this company for the next 5 to 10 years, regardless about what the stock price does in the short term, it could pay off in the long term. However, me personally, I'm waiting for shares to get cheaper, and honestly, I'm just holding my stocks right now because of the current negative macroeconomic environment. I'm doubling down on more blue chip companies, ETFs, mutual funds, as well as index funds. But with that being said, let's move over to a fintech company and a digital bank called New Holdings, which currently trades at $4.50 per share, while professionals believe the company should be worth anywhere between $3.30 on the low end and $12.50 on the high end. Like I said earlier, this is a digital banking company, and they're located over in Brazil. But clearly, the financial industry, fintechs included, have been hit very hard, and a lot of growth stocks and technology stocks that are trading at higher premiums are being hit very hard right now due to the Federal Reserve increasing interest rates by around 75 basis points. And the Fed also said that it plans to increase and continuously increase interest rates in and through 2023 until inflation gets under control. And I 100% agree with them. The only problem about this, which is why we are seeing the overall stock market become very red recently, is that the Fed could end up spurring on a recession. And technically, we are in a recession right now because we've had 2 quarters of GDP decrease quarter over quarter 2 times in a row, which is the technical definition of a recession. So technically, we are already in a recession. However, the recession isn't that bad as of right now. But if the Federal Reserve continues to increase interest rates to get inflation under control, this could cause a recession much faster, especially if they do it too quickly. Now, I don't think it's going to be catastrophic because the Fed is literally implemented to control inflation and to control things like this to prevent the economy from collapsing. And I think that they are very good at their job because overall, the stock market and the economy over the long term have always come out on top. But that doesn't mean investors right now aren't worried about a recession or a global recession, which is why a lot of investors are liquidating the risky stocks. It's why the stock market is crashing right now due to fear and FUD in the market. And this is why I think investors should really double down on their core investments like ETFs like VOO and VTI, especially during times of uncertainty. New Holdings, like I said earlier, is a fintech company, and they grew their users by a very healthy pace, and they increased their revenue by 230% from the same quarter a year ago, resulting in a sharp price increase of around 16% last month. But despite that, investors are still looking at the big picture of the global economy, which is very bleak right now because we are in the middle of a recession. So this is clearly hurting banking companies, fintech companies, and digital banks, which doesn't necessarily make New Holdings a bad investment, but it most certainly doesn't make it a good stock right now. So for me personally, I think this is too much of a risky stock to invest into right now. I would much rather prefer a company like SoFi Technologies, which is another digital bank and fintech company. But even during the current environment, I just plan to hold my SoFi shares. I want to double down on my core investments, not my speculative growth investments right now. Which leads us over to Tattooed Chef. Ticker symbol TTCF, and New Holdings ticker symbol was NU. Tattooed Chef currently trades for $5.16 per share, while professionals believe it's undervalued right now because it should be trading at anywhere between $8 to $10. But with that being said, I would say that there aren't many analysts or professionals actually reviewing this stock right now. Tattooed Chef was an extremely hyped stock back in the day that I never really covered because I never really liked Tattooed Chef. So clearly I have somewhat of a bias here. And recently, my past comments comments have come true, in the sense of they've missed both their revenue and earnings estimates, and their margins fell by around 1.3% during that quarter. So clearly this is a very risky stock, and there's not a lot of data surrounding it that we can harp on, and we'll get into it more. Now, what I do like about the company is that their top of the line growth is absolutely insane. The company grew its top of the line growth by around 44% in 2021, and again by 37% during the first quarter. However, since then, the growth has tapered off and decreased to where during the last quarter it's only increased by around 15%. And ideally on this channel, we like to find high growth companies that are growing their revenues by around 30% or more over the next half decade, because that is an insane growth rate. But even anything over 20 to 25% for a company that is trading at low accounting ratios are very impressive. The company's attributes and the revenue growth is mainly attributed to its acquisitions. Recently, it has undergone 3 major acquisitions, with New Mexico Food Distributors, Karsten Tortilla Factory, and Belmont Confections. So this begs the question, what about the company itself? What about the Tattooed Chef brand? How is that growing? Well, if we're talking about organic revenue growth, it only grew by around 3.4% year over year, which is substantially less impressive than the 15%, the 37%, and the 44% growth rate that we've seen due to the company's acquisitions. Now, I think Tattooed Chef is going to be rather resilient during times of stock market uncertainty and even a recession, because the company has reported that their customers have incomes of over $100,000. So even if the economy gets tough, these customers are still going to be buying Tattooed Chef products, because clearly they are a pretty successful food company that is sold in a multitude of grocery stores. Now, what I don't like about the company is that the management hasn't really focused on the profitability of the company, and I think that's going to be something that they should be focusing on. Now, I do want to say this about the company, that their newest distribution agreement with Walmart is going to be phenomenal for the company, because Walmart is clearly a giant retailer that is going to put their products in the front and center. So I think that's going to reflect very positively on their overall revenues. Now, with that being said, the share price of this particular company has declined by around 80%, which means that their accounting ratios may be in a good enough spot to consider a buying opportunity, where their PS ratio, which is their price to sales ratio, is trading at around 1.7 times, which is really good for a growth stock. The company's also trading at around 18.5 times its full year gross profit guidance. So again, that is also pretty positive. So those are the positives for this particular company. Let's go over some of the negatives. Well, the business on their balance sheet has around only $28 million of cash or cash equivalents on their balance sheet, so clearly they don't have a lot of cash on hand compared to other companies. But they used to have a strong balance sheet, but they're going through such major cash burn, because a year ago for the same quarter they had around $140 million on their balance sheet. So clearly they have burned through a lot of cash, either buying other companies or just through their burn rate, to where right now the company's free cash flow burn rate is around $20 million for the past few quarters. So who knows how long that cash on their balance sheet is even going to survive before they burn it up. But management is clearly aware of this, which is why the company went out and added around $50 million worth of assets for their backed line of credit for their assets in case they need immediate liquidity. So my final verdict on this particular company would be, yes, this could be a good company. I really like the accounting ratios trading a lot cheaper than what they were originally when I was hyper skeptical about this company, and because the stock price has dropped by 80%, it's definitely a better buying opportunity than it was. But considering the poor profitability and weak fundamentals in terms of their weak balance sheet, I don't think this is a good buying opportunity considering the current stock market environment. If anything, this is a stock that we could put on a watch list. Lastly, we're going to talk about FUBO TV, which is another speculative growth company that trades at $3.65, while professionals and experts in the field believe the company is undervalued and how it should be trading at $5 to $8 per share. So what's happened recently? Why is this company so cheap? Well, recently the stock price has actually increased slightly because an analyst upgraded their price target and rating for the company, and that analyst is Michael Patcher, who works for Wedbush, a very prestigious institution, and he believes that FUBO TV is going to beat the market, which is why he upgraded the stock to a $6 price target, which represents a 50% upside potential for investors. But clearly, we need to take analysts and these price predictions with a grain of salt. They're only guidances, they're not law. It's just something that we need to be aware of, but we definitely shouldn't invest or not invest based off of those projections. This particular analyst believes the company is going to become profitable in 2025, and with companies that are going to become profitable further out, I would much rather wait until 2024 or 2025 to invest to see if their management is actually on track for the company to achieve profitability. But with that good news saying that yes, they can become profitable in 2025, I want to highlight two reasons why investors should be cautious about this particular company. First off, it's having a hard time monetizing their overall users. If you didn't know, FUBO TV is a sports streaming service, so clearly their main audience are sports lovers, and right now they're having a hard time monetizing them, which is shocking because the monetization for sports lovers are very, very high. The company's second quarter results actually showed a lack of progress in terms of their ability to monetize their users in terms of their advertising, which is where the bulk of their revenues come from. They right now have an average revenue per user, also known as an ARPU, of around $7.25, which equates to a decline of around 18%, which is not good. Management has blamed the current macroeconomic environment for this decrease, and I say that is actually a pretty good excuse. Secondly, I'm going to say that their sports book is not impressive. But what is their sports book? So basically the company, because they are a sports streaming service, they began building out a sports wagering business and a sports betting business in 2021 called Sportsbook, which I think was actually a pretty smart move. If you are streaming sports, you could also offer these sports watchers an ability to bet and wager on the sports that they are watching. I think that was a fantastic move for this company to take. However, the problem is that they are burning cash to keep this particular segment of their business alive, and it's going to be a long time until this particular segment reaches or actually pays off in terms of profitability. Management announced that it's actually going to take a second look and put this sports betting business under strategic review, so hopefully they can pursue the long-term opportunity that I do believe is in that technology. So right now, this is a very speculative stock that I don't think investors should be buying during times of macroeconomic uncertainty. But there are positives to this company. For instance, in 2022, the subscriber growth rate was around 41% year over year comparatively, which drove around their total revenue growth of 70% year over year up to $221.9 million. The company also trades at a very impressive price to sales ratio of just 0.8, below a 1, which many investors believe that because of that accounting ratio, that it's significantly undervalued right now. And I can agree to disagree with them. Yes, that is an extremely low PS ratio for a growth company, and it even outclasses the S&P 500's PS ratio, which normally trades around a 2.2. So if you can identify a growth company that's trading under 2.2 from a price to sales ratio perspective, that is a very good company. I don't like the company's management, and I do think that they are extremely unprofitable, and the competition is just very, very tight. FUBO TV was the fourth largest player in their respected market, behind Hulu Live, which is owned by Disney, YouTube TV, which is owned by Alphabet, which owns Google, and Sling TV, which is owned by Dish Network. I would much rather invest into companies such as Alphabet, which owns Google and YouTube, and Disney, considering the current stock market environment, instead of investing into FUBO TV. Now again, this does not mean that FUBO TV or any of the other companies on this list are bad companies. It's just saying that right now the macroeconomic environment is so risky, you probably want to double down on your core plays in ETFs and index funds and mutual funds and diversification and blue chip companies and value stocks. You don't want to focus on technology stocks or growth stocks or very speculative stocks right now, because it may not pay out for you over the long term. But with that being said, I would love to hear your thoughts down below. Remember to go and smash that like button right now, comment your thoughts down below, subscribe if you are new, and I will see you in the next YT video.